Now we see the classification of markets. How are markets classified? On what basis are they distinguished or differentiated or classified? First, on the basis of area. Second, on the basis of time. Next, on the basis of nature of transaction. Fourth, on the basis of regulations. Fifth, on the basis of volume of business. And finally, on the basis of types of competition. We'll do all these types in detail. So let's start. First, on the basis of area, it is further divided into four markets. First local, second regional, third national, and fourth international. Okay, so let's start with local market. Now, what is a local market? A local market is a market which exists in a local area, in the area surrounding your residence or profession. It may be an area in the radius of a kilometer or two, not more than that. So it's a local market. Now, what kind of things do you get in the local market? You generally tend to get the perishable items in the local market, like milk, like fruits, like vegetables. All these things have a local market. Again, things which are very bulky and inconvenient to transport are found in the local market, like sand, like bricks. These are bulky items, so you get them from the local market only. So there's a local market for goods which are perishable, which we consume for our daily needs, and finally goods which are bulky in nature. Next we have regional market. Now what is a regional market? Regional market is a market which caters to a region, maybe 3 or 4 localities at a time, or maybe a district or city. It tends to cater to the whole city or a whole district at a time. So what kind of things do you get in a regional market? Generally, you tend to get semi-durable goods. Now, what are semi-durable goods? Semi-durable goods are those goods which tend to have a life of more than perishable goods, which tend to have a life wherein you can use them for some period of time. Generally, the goods like clothes tend to have a regional market, or maybe goods which are made of plastic tend to have a regional market. So these are the goods which you tend to use for some period of time. They do not get extinguished, they do not get completed by use in one use. So you tend to use them in a recurring fashion. So in the local markets you have perishable goods which do not have much of a life. In the regional market you have goods which are semi-durable in the nature. Third, we have national markets. What are national markets? National market means a market wherein the whole country is covered. Goods which have a national market. You can get those goods from anywhere in the country. There's a national market for it. There are a lot of goods which have national market. Generally, the durable goods. For example, the goods like cell phones. They have a national market. You can get a Samsung phone anywhere in the country. You can get a LG TV anywhere in the country. So these goods which are durable, which have a life of more than semi-durable goods, which have a longer life, which tend to remain with you, which tend to be usable by you for maybe 3 years, 5 years, 7 years, 10 years. These are durable goods. And finally, we have international market. International markets are those markets which cater to the whole world. Goods which have markets which can be traded anywhere in the world. Generally, precious goods have international markets. Precious goods like maybe diamonds, gold, silver, these are precious goods. So they have international market. You can buy gold from Dubai, you can buy gold from Thailand. At the same time, you can buy diamonds from America or maybe Belgium. So such goods have international market. The next classification is on the basis of time. On the basis of time, markets are classified as very short period market, short period market, long period market, and very long period market. Now, what is a very short period market? Very short period market means a market wherein the supply of goods cannot be increased. The supply of goods is fixed. The supply of goods is inelastic. That is, you cannot change the supply of goods. You cannot increase or reduce the supply of goods. Because what happens is, to increase or decrease the supply of goods, you need to change the factors of production. You need to employ more labor. You need to employ more capital. But since it is a very short period, you cannot change these factors, and thus the supply cannot be changed. So, a market wherein supply cannot be changed is called a very short period market. Generally, a very short period market is for perishable goods. Perishable goods have a very short period. We cannot change the supply of perishable goods in a short period. If I want to change the supply of oranges, it will have to take some time. I'll have to buy more land. I'll have to cultivate it, fertilize it, till it, and then finally harvest it, which will take me around 4 to 6 months. So, in a very short period, let's say a day or two, I cannot just change the supply of oranges or maybe any other fruit for that matter or any other vegetable. So, such a market wherein the supply is inelastic is called a very short period market. Next, we have short period market. Now, short period market is a market wherein supply of the goods can be changed, but only to some extent. Now, why only to some extent? Because the answer for this, we've already done this when we were studying the theory of production. There we had studied what is short run and what is long run. So, short run is a time period wherein only one factor of production is variable. So, since we can vary one factor of production, we can change the supply of the goods, but not by a large extent. Only to some extent we can change the supply. So, what kind of goods have a very short period market? Generally, the goods like garments, goods like pens, they have a short period market. Their supply can be increased or reduced in the short period. Now, what is a long period? Long period is a period where all the factors of production are variable. Since all the factors of production are variable, you can change the supply at will. You can increase or decrease the supply of the goods. So when all the factors of when all the factors of production become variable, you can change the supply. But it is important that for this purpose, the period of time is longer. And thus, because the period of time is longer, we call it a long period market. Finally, we have a very long period or a secular period market. This market is observed in a very long period of time. The analysis is done in a very long period of time, maybe a year, 2 years, or 5 years at a time. The market is studied taking very long periods at a time. And thus, what happens is when you consider very long period, the market becomes secular. Secular in the sense that the forces of demand and supply act against each other, and thus they set the equilibrium in the market in terms of price and the quantity as well. So you allow the demand to set the price, you allow the demand to set the quantity, you allow the supply to set the price, you allow the supply to set the quantity, and where both the demand and supply meet, you say that you have reached the equilibrium. So this is a market wherein you allow the demand and forces to dictate. Let them set the price, let them set the equilibrium quantity. The next type of classification is the classification on the basis of transactions. On the basis of transactions, the market is divided as spot market and future market. Now, what is a spot market? Spot market is a market where the goods or services are transacted at spot, at that point only. It's not like the transaction is about delivery of goods at a future price. You buy the goods at that point, you make the payment at that point on the spot. Such a market is called the spot market. The example for this would be the normal markets where we go and buy goods. Maybe a garment market where you go and buy your garments, jeans, shirts, or maybe a market for groceries. It's a spot market. A market for stationery. It's a spot market. So all these markets where you purchase goods on the spot and make payment on the spot is called the spot market. So what is a future market? Future market is a market where the goods are traded in future. The agreement is done today for goods to be delivered at a future date, for payment for those goods to be made at a future date. You do not transact, you do not agree to deliver the goods on the spot, but you make an agreement in such a way that you will deliver the goods at some future date and you will receive the payment at some future date. So this is called a future market, wherein you transact today for goods to be delivered or payment to be made at a future date. Generally, if you see today, stock markets and commodity markets have future markets. You must have heard about something going like this. The Reliance futures are trading at 2500. The Reliance spot is trading at 2000. That means if you purchase Reliance today, you'll have to pay 2000. But if you transact today for purchasing Reliance, let's say 3 months hence or 6 months hence, you'll have to pay 2500. So when will you get the shares of Reliance? You'll get them after 3 months or 6 months. But you are transacting today for it. In the same way, you transact for commodities. You transact for the futures of commodities, let's say futures of gold or futures of gas. You transact today to purchase gas which will be delivered after 6 months, which will be delivered after 9 months. So such a market wherein the delivery happens at a future date is called a future market. MCX is the example for it. MCX is the example for it. MCX means multi commodity exchange. It stands for multi commodity exchange. It's a market just like a stock market. In stock market, stock of shares are traded. In a commodity market, commodities are traded. So MCX is a market wherein commodities are traded online. The next classification is classification of markets on the basis of regulations. Now, how can we classify the markets on the basis of regulations? It's in terms of, does that market have a regulatory body? Is that market regulated by a body which overlooks the functions, which overlooks the norms, which sets the guidelines for the market? Now, you may wonder as to how a market can have regulations or a regulatory body. It certainly can have. You must have heard this word, SEBI. Now, what is SEBI? SEBI is the regulatory body for stock markets. The stock markets are regulated by SEBI. SEBI, by the way, is Securities and Exchange Board of India. It sets the rules, it sets the regulations, it sets the norms, guidelines, and principles for all the transactions that are taking place on the stock markets. So we can say that the stock markets are regulated by SEBI. Thus, stock markets are regulated markets. Likewise, the insurance market is regulated by IRDA, Insurance Regulatory and Development Authority. It regulates the insurance markets. Again, you must have heard this word TRAI, Telecom Regulatory Authority of India. It regulates the telecom industry. It regulates the telecom markets in India. So these markets like banking market, which is regulated by RBI, telecom market, which is regulated by TRAI, insurance market, which is regulated by IRDA, stock market, which is regulated by SEBI. These markets are regulated markets. They have a regulatory body. The other kind of markets is unregulated market. Unregulated market is a normal market like a vegetable market which does not have any regulatory body, or maybe a market for agricultural products. It does not have any regulatory body. A market wherein you buy and sell garments, it does not have any regulatory body. There are no rules and regulations for those markets. So such markets are unregulated markets. Even for electronics, you do not have any regulated market. You do not have any regulatory body setting regulations for TVs or mobile handsets or maybe music systems. So these are unregulated markets. The next classification is on the basis of volume. Volume means the amount of transactions, the number of transactions. So on the basis of volume, the markets are divided into wholesale market and retail market. Now we've studied these markets in our lower standards. A wholesale market is a market wherein goods are sold and purchased in bulk. Bulk quantities of goods are sold and purchased. So when the quantities are in bulk, the volume has to be more. So the markets where the volume is more are called bulk markets or wholesale markets. Generally, the producers tend to sell the goods to wholesale markets, and from wholesale markets the retailers purchase and finally sell them to consumers in the retail market. So the chain goes like first the producers, then the wholesalers, then the retailers, and finally the consumers. So the market from where the retailers purchase the goods from the wholesalers is called the wholesale market. because the retailers purchase in higher quantities but they sell it to the consumers in smaller quantities. For example, we have the APMC market near Vashi in Bombay. Now, this is a market wherein fruits and vegetables or agricultural produce, in short, is purchased and sold in bulk. The vegetable sellers purchase all their stock from this APMC market and sell it to retailers in their respective regional or local markets. Likewise, we have a very big flower market near Dadar. Now, the sale and purchase of flour in this market is so much that we consider it to be a wholesale market in terms of volume. So the flowers are purchased in wholesale from this market in large quantities, in bulk quantity from this market. So a market wherein you purchase the goods in large quantities, in bulk quantities, becomes a wholesale market. So what is a retail market? Retail market is a place wherein you purchase goods in smaller quantities. Like you purchase milk or bread or eggs from your retailer, you purchase them in smaller numbers, but your retailer stocks them in larger numbers. So the retailer would be purchasing from the wholesale market, whereas the consumer would be purchasing from the retail market. A retail market is where the final consumers purchase it from the retailers. The final classification of markets is on the basis of competition. The competition amongst the sellers determines the market they are in. Now we have various types of markets depending upon the competition between the sellers. The first is perfect competition, second is monopolistic competition, third is oligopoly, and finally we have monopoly. Now let's understand what is perfect competition, what is monopolistic competition, what is oligopoly, and what is monopoly.